something you've covered already?
Profit warnings.
Profit? Oh gosh, I don't want any of those.
Hi, thanks, David. Yeah, just to say thanks to David. This has been such a brilliant session. It's so good to spend lots of time talking to everybody here, and really enjoyed it. 2 nights. I had a bad hangover this morning, and I blame Paul Scott, who won the poker, poured all the winnings into champagne. So I think he's not up anyway. But I think he did make his session this morning better than last week. So it has been a colourful week, controversial week. I'm not going to go into the details. I'm sure some of you know what I'm talking about. But this has been a very jolly end to the week, and very nice to get the award. So I'm going to be talking about profit warnings. I don't think it'll be a full hour, probably more like 40 minutes. And many of you may have seen this before. We initiated a study at Paul Scott's request to study the impact of profit warnings. And for those of you who might know me, I'm quite interested in the behavioral psychology of investors and how often our biases can lead us into suboptimal decisions. Actually, Alan Morris has got a session on at 4, which I'm sure will be very interesting on that note this afternoon. So this is called the Profit Warning Survival Guide. I will be talking a little bit about the project and what it is and was. And then I'll be talking about the anatomy of a profit warning. We've built a model of the average profit warning and what happens, which I think is very eye-opening, and you can get a lot of insights from it. We're going to be answering quite a lot of questions that I'll be showing you on the next slide. And then we're going to be talking about the traits of profit warning stocks to see if there's any ways we can avoid them or minimize their impact in our portfolio. And then I will talk about some other insights on psychology, show you how you can get the PDF of this research, and happy to answer any questions afterwards. There's never any time to read that many words in a presentation. Okay, about the project. Why study profit warnings at all? Well, look, we've all investing in the market, and has anybody here never been impacted by a profit warning? Hands up if you've never had a profit warning in your portfolio. Okay, so it's pretty widespread having to deal with this. So listed shares often have profit forecasts from the analysts that set the share valuation and price. And obviously when bad news hits, companies announce a profit warning to reset expectations. And then, bad things happen on those days, as we've all experienced. So the key question is what to do, what should we do next? Because consensus opinion often seems to be that we should buy or hold when these things happen. And I think, we wanted to sort of check whether that was a good idea or a bad idea. So there were some goals of this study. I wanted to figure out how far do stocks fall on a profit warning? If a stock suffers a profit warning, is it likely to recover? Should you buy, hold, or sell on a profit warning? Is there any way to avoid them? What sectors are most hit by profit warnings, and do profit warnings overreact and thus bounce? So there's a bunch of things we wanted to kind of figure out, debunk any myths, and really get some clarity from the data. Now, this study was initiated. Paul said to me, I'd really like to do something on profit warnings. And of course, Paul's been very prolific, writing almost every day on stock markets and on stocks. And one of the things that he often does in small cap reports on the site is often he will start with, another profit warning. So he'd been writing for years, and there was actually this wonderful archive of content which we could search for the phrase profit warning. And so using that as our first primary source on small caps, we were able to build a database of 245 profit warnings between January 2013 and August 2016. It was predominantly, although not exclusively, small caps in the UK. So I had some interns into the office, and someone was managing them, and they collectively went and gathered all the dates and names of the companies through the small cap report, but also going and looking on RNSs at the time time for companies that said they'd missed expectations. We gathered and verified and analysed all the data and set it into a database. And then we identified the date of the next price impact, because some will announce their profit warning before the open, some will announce after the close. And what we wanted to do is we've got all their price charts and we linked them all up so that they all synchronized on day 0 of the profit warning so that we could build a model. And then what we did is we analyzed all our price database, history database, and also our fundamental archive to see if we could find out any of the traits of these profit warnings. And at the time, most of the writings, when he was writing, it was sort of Paul doing this sort of marathon solo session. Obviously, Graham has joined him now, so we will be extending this study again in the future. Obviously, when you spot a warning, you get these kind of key phrases, and it's they often try and dress it up positively. So there's sort of examples of companies saying we're broadly in line with expectations, but and that can be a profit warning, or they could be a little bit more candid and say things are very significantly below market expectations, etc. It all depends on the PR spin around the announcement. They will never come out and go in their announcement, we have a profit warning. So it tends to be what a sort of a different sort of phrase. So I'm going to show you the next slide, the anatomy of a profit warning, because putting all of these charts together, we built a composite chart from hundreds of these profit warnings, and it looks like this. Now let me explain this chart. You've got, on the vertical axis, this all starts at 100%, which is, you can't see my mouse, but on the left, which starts about 6 months before the profit warning. The blue area is the share price of the average profit warning. And you can see that on the day, this massive collapse in price I'm sure we've all witnessed. And then afterwards, you see another year and a half later, what happens after that date. So this is the average journey of a profit warning. Now the grey line I've put on here is, because these profit warnings happen at different times all over the course of multiple years, that grey line shows the average return of the FTSE over that period. So you can think of if you bought after, or you held after the profit warning, that grey line shows you what the FTSE might do over that period, and the blue line shows the underperformance. I'm going to go a little bit deeper into this. And one key point is day 0 there is the profit warning, and this axis is in trading days. Now, of course, there's no trading at weekends, so all this goes up to about 350. That's actually a year and a half, because weekends aren't included. So I'm going to look now, zoom in on this part before the profit warning, the 6 months before. So from 6 months before, you start seeing this decline in price on average, and it seems to accelerate. I hope you can see in that bottom corner. But it accelerates in the days before. It might be the lectern might be obscuring that, but it accelerates in the week before. Now, there's multiple reasons why this might happen, but and one might be that the industry group is having a bad time. Another could be that there's information leakage from the company. That it's perfectly possible that information is getting out that a company is having a bad time, but I think it's a little bit suspect that they kind of decline so quickly before the profit warning. So I think one of the key signs that something might be amiss is underperformance of the shares over the 6 months before the profit warning. And then on the next chart is an intraday chart of during the day of the profit warning. And you can see this starts at 100% and drops down to about almost 18% at the open is the average decline intraday. And you actually see, on average, they trade off. I think it was about a 20% fall on the day, and you can see that on average they don't bounce, although there is a huge distribution here, and I think that it's a nice picture of what happens on the day, and they're not the nice days for us as investors. This is from the profit warning to 18 months later, so you can see the day of the profit warning there. And then you see that they generally keep declining up to about 6 months after the profit warning, and this is across many different profit warnings, and you see this almost like 6-monthly cycle, where 6 months before they start declining, there's a profit warning, then 6 months later they bottom, there's a bit of a rise, and then 6 months later they bottom again, and it's almost like an oscillation, and I think that mirrors slightly with interim reporting periods of stocks. But I think you can see that generally, on average, and I am talking about averages, stocks tend to keep declining after a profit warning. So once again, that gives you the full picture of the profit warning. Now, this does suggest that people do not sell enough when companies warn on profits. And that grey line here again shows you that opportunity cost, that if you just switched out on the day of the profit warning into a FTSE tracker, which I would never recommend, but it does show you that holding on to the average share means that you could be missing out on quite sizable return difference. So here's just some statistics. And I think this is important to understand from the distribution perspective. After a year had passed, only 13.2% of stocks in the study ended with their share price back above the price before the warning. So that's almost like 1 in, I guess, what is that, 1 in 8 or something, actually end up recovering back up to their pre-profit warning price. Only just over 30% of stocks managed to gain 5% or more a year after the profit warning had taken its toll, but 44.5% of stocks lost an additional 10% or more from the day of after the profit warning till 1 year later. So you can see it's almost 50% of stocks actually kept declining another 10%. So the next slide shows you, do profit warnings bounce? There's a lot of people, profit warning, and they go, I'm going to trade the bounce. What we've got here on the left is the drawdown on the day, intraday, to the low. So you've got that's from 0 down to minus 100%. And then on this axis, the maximum gain afterwards. So you can see that there is a sort of correlation here that stocks that decline the most are more likely to have a bigger bounce. But one of the problems with trading a profit warning is that the spread widens massively on the shares. So actually being able to capture any bounce is actually quite an expensive thing. But I think, the general outcome of this is that you only want to think about trading a bounce if there is a huge fall on the day. But even then, it's really dangerous. Do profit warnings come in threes? So in the study, we found that about 64% of stocks only had one profit warning, but that's more than a third that did have more than one. So there is some sort of serial correlation in profit warnings. 1 in 4 had 2 warnings, and probably 11% had 3 or 4, so had multiple. And obviously, there is that old saying, profit warnings come in threes. I mean, there is some merit on that. I think companies may be getting better at putting all the bad news in one warning. But, that's more than a third are having another. So this is just a quote from Robbie Burns. He's a great guy, colourful character. It's crazy to buy into a company that's just produced a profit warning, and it's crazy to hold on to one of your shares that's just issued one. It's more likely that it will issue another one, and just because its share price has gone down doesn't mean it won't be going down some more. Now he's just getting that from tactile experience in the market, but the statistics obviously I've just shown you definitely back that up. So some of the key insights here that I want to take from this section of the talk is, when profit warnings strike, consider selling or selling short. It's often best to sell as soon as possible when you get the bad news. Only consider buying after a profit warning if at least 6 months have passed, and preferably in a bull market. So there is some research that shows that buying profit warnings in bull markets it can be a profitable activity. Buy the bounce only if the shares have fallen by more than 30%. There's a case study from this study, MySale, which shows you the kind of classic picture of a profit warning, and then 18 months later the recovery starts, but still pretty moderate. Now, I wanted to share with you, when I originally presented this in a webinar online, I said, here are 3 profit warnings at the study end date to watch unfold. And I thought it'd be quite good to go and look at how they actually did, because at the time they'd only issued a profit warning literally a month or 2 before. So Capita, Crawshaw and Braemar Shipping Services were the 3 ones that I said warnings to watch. So let's look at Capita originally. Firstly, you can see that was the original warning. and I said, let's watch it. And then over time, it recovered a little bit. But then, of course, as we know, it had another profit warning at the beginning of this year. So you're seeing that decline, quite consistent decline there. Crawshaw, the original warning, and then barely a happy day for investors since. So, you know, the picture there hasn't been a recovery yet. And, you know, it's been probably more than 18 months since. Braemar Shipping Services, original profit warning. And we probably said about only a couple of months after that, said this is one to watch. How will it unfold? And you got that second profit warning right there. And it's obviously had a pretty bad time since. So I think those three that I said let's watch, you can see that the general picture has played out pretty much as expected. So I'm going to go on now and I'm going to talk about the traits of profit warning stocks. And I'm going to do this through, you know, those of you that know me, I believe very much in factor investing, which using these three lenses of quality, value, and momentum. And one of the things we do at Stockopedia is rank the market across these dimensions. I'm sure lots of you are subscribers, and I don't want to spend much time on this, but the idea behind it is that cheap stocks beat expensive stocks, that's value. Good stocks beat junk stocks, that's quality, and momentum, strong stocks, tend to beat deteriorating stocks. And we take multiple metrics, so we'll measure value by using a set of 6 metrics, which includes the price-earnings ratio, the yield, the price-to-cash flow, and a few other common valuation ratios to create a composite. And then we will rank the market across that composite into these 3 numbers from 0 to 100, where 100 is best across each of these dimensions. And this gives a very nice lens through which to look at profit warnings, so that we can actually look at the traits. So to see, like, you know, which types of stocks are more likely to issue profit warnings. So this is a histogram, and on the right you have higher quality. This is quality. Profit warnings versus quality, and it's a histogram. So the highest quality shares are on the right here, lowest quality on the left. And this is the count of profit warnings in each of those 5 buckets. So as you can see, higher quality shares tend to issue more profit warnings. Now, obviously, higher quality companies are the only ones that have profits. So it might be expected that profitable shares will have profit warnings. The kind of shares at the other end are less desirable in terms, they don't have profits, and often expectations are quite low. So, you know, you tend to find less there. But this might also reflect the universe of shares that Paul wrote as prolifically on during that period, and his universe does tend to focus more on profitable shares. But you can see that higher quality shares tend to have more profit warnings. This is against the value rank. So this is profit warnings against their cheapness. So you've got cheap shares over here, expensive shares over there. And you can see that the cheapest 20% of the market, or on the site value rank of 80 plus, those are the cheapest, they have more incidents of profit warnings. And you can think, yes, the price may be declining, the shares may be getting cheaper, but it might also reflect that there are certain sectors where you find more cheap shares that may be more cyclical, which will be impacted more by circumstance. And I'll be looking at the sector breakdown shortly. Yeah, this one next slide is quite interesting. So this is against momentum. So momentum on the right is the high momentum shares that are going up, and on the left there are shares that are going down. Now we already saw on the anatomy of a profit warning that 6 months before a profit warning, the companies start trading off. So we already know that stocks that are weak often show more profit warnings. But you see this big clump in lower ranked shares for momentum, and actually the lowest incidence of profit warnings is in very high momentum shares. So shares that have got, and this is one of the best ways to avoid profit warnings, is owning higher momentum shares. And I know a lot of people don't like investing with momentum because they don't like buying things that are going up because they think they can get bargains. But if you buy bargains, you're going to be more at risk of profit warnings. So I think that's quite an interesting slide. Next up, I've got the fall on day versus the stock rank, which is the composite of quality, value, and momentum. And this shows you a scatter plot with the higher ranked shares on the right, lower ranked shares on the left. So you can think kind of worst prospects to own in the market are over there. Best sort of prospects are over here. But you see, and this is the decline on the day from that straight black line. And I don't know if you can see because it's very faint, but there's a little green trend line, which is practically horizontal. And what that means is that basically you're as likely to see profit warnings in bad company, they're completely scattered across the market. That's really the message I want to say. So, buying, you almost can't avoid them, and we just got to accept them as part of our kind of daily life. But the next slide is quite interesting. The only correlation I could find was that much higher quality shares, more profitable shares, higher margins, more cash flow, had a propensity to have to recover the best. Now, there's still only a low correlation, but this shows the performance of the shares over the next year. So you can see that this bundle of shares up here, they're the higher quality shares, and there is a small tendency for them to recover better. And my rule of thumb on this is that a quality rank of 80 or better are the only kind of shares that I would be willing to own after a profit warning. All the others, personally, I sell immediately. So I think that's a useful insight. And a good case study for this idea of quality is Boohoo. I'm sure a lot of people here owned Boohoo and have probably done very well out of it. And congratulations. And Paul Scott was one of the few people who was saying buy after that profit warning. And I got the stats for the rankings. And as you can see, the quality rank after the profit warning was 87 up there. And I've got a quote from Paul. There was nothing at all wrong with the figures at Boohoo, in my opinion, and I checked them quite thoroughly. It was a rare beast, a high-margin online retailer throwing off organic growth from international expansion with a growing cash pile, yet where market sentiment was, in the short term, negative due to a failure to meet very aggressive broker targets. I saw this as an opportunity, but only if growth continued at a reasonable pace, which is what happened. And I know this chart only goes up to the time when we actually published this research to begin with, but it's now more than doubled since. So, I mean, that's a case study of higher quality business actually recovering. We're now going to have a little look at the sector breakdown of profit warnings. And these are we have 10 sectors on the site, and I've color-coded it so the defensives are in green, cyclicals are in red, and what we call sensitives, which are sort of in between defensive and cyclicals, are in amber. And you can see that the majority defensive sectors like consumer defensives, that's food and beverages and other products similar. There were very few profit warnings. Similarly, in the healthcare sector, so those sorts of defensive sectors tend to have less profit warnings. And I think a lot of people don't own many defensives because they tend to be lower volatility. But actually, getting spine in your portfolio by owning really sort of good defensive shares is always a wise thing. You see a lot of profit warnings in consumer cyclicals. So they tend to be the kind of bigger priced items that you might buy, like cars or fridges or anything like that. So consumer cyclicals, there are more profit warnings. But also in that industrial sector, which is quite a large sector on the other side, and tech stocks, you generally saw more profit warnings. So more economically sensitive areas tend to see more profit warnings. So I guess the message from that slide is, you want to avoid profit warnings, own a few more defensives. So the key insights from this section on the traits of profit warning stocks, again, is that it may be impossible to avoid profit warnings completely. Owning defensives can minimize profit warnings in a portfolio. Avoid the cheapest shares, and it's the trouble with deep value investors and bargain hunters, is they often will buy shares which are maybe value traps, and value traps often do have profit warnings. Avoid underperforming shares, or stick to higher, more shares with more momentum. Underperforming shares this idea of momentum works both ways. So winners tend to keep winning, losers just tend to keep losing. So it's a kind of a rule of thumb. A lot of people like to use things like the 200-day moving average as an indicator of when to sell. I think there's some merit in it. And only hold or buy the highest quality shares after a profit warning. That's probably the most key insight and the only real trait that I could dig out of when to hold is having high quality shares. So I'm just going to go on and talk a little bit about psychology. As I said, Alan's doing a big chat on this later, and I'm going to go to. Because one of the things that happens after a profit warning is if you go on a bulletin board or you talk to people, you get comments like this, and these are real comments after a profit warning. AO World. This is from comments from subscribers in the community on the site. If any of these were your comments, I do apologise for bringing them up here. You don't have to raise your hand and say it was yours. I won't try and, the less I say on that, the better. But so this one comment. On that day of the profit warning for AO World, I did not think the profit warning was that bad. The company expects the results for the financial year ending 31st of March will fall slightly below expectations. Maybe the fall of 30% is a bit overdone, ? And continued to trade off. Hargreaves Services. I think Hargreaves Services may have more prospects than suggested. HSP, perhaps it's a get-rich-slowly situation. Think I'll stick with them just now. And you can see what happened there. It fell from 750 down to 250 over the next, wasn't a get-rich-slowly situation. And Stanley Gibbons. The profit warning here looks to me like fairly transitory issues, which are already being fixed. This share has really been smashed down in price and is starting to look potentially good value for a recovery, maybe. And I don't know if you can see that one, but well, I think a lot of you know what's happened to Stanley Gibbons since. So, but the point is, yes, I did cherry pick those, but you do see them all the time in profit warnings. And I would just say watch your psychology, because it's a battle. It really is a battle for the mind in the market. And hanging on to things just because you know the story, you know the company well, it can lead to negative returns. So it's a battle for the mind. And there's just a few key points. I did a big seminar on this at the UK Invest Show a couple of years ago, and which is on YouTube, called Managing the Monkey, and it was a really fun session. So do search for it on YouTube if you want to learn more on this topic. You're averse to taking losses. There is this whole idea of loss aversion, that we are reluctant to take losses, and it really is a thing, and it's one of the most expensive traits, actually. So learning to cut losses on things which are, have a negative prospect is a really, really good habit to have. We all say run winners, cut losses, but practically nobody does cut losses. And you may be following narratives rather than facts. There's this whole idea of a narrative fallacy, that we as humans are kind of hardwired to believe in stories, and we create these narratives in our minds that only have positive outcomes because we want that fairy tale Hollywood ending, and so often it doesn't come out. And Nicholas Nassim Taleb, the great author of so many good books has talked about this many times, and it's such a key point. Also, we get anchored on previous prices rather than reality. So if you bought at a higher price and there's a profit warning, it's very hard for us to reset our expectations to believe that the new current price is true. So you have this anchoring to old prices, and it makes you reluctant to sell until you get near them. And that's another reason why there's not enough selling pressure on profit warnings, because people are very anchored on higher prices. So, all these sort of behavioral biases are like bugs in the mind, and we need to try and somehow purge ourselves from them. And I think this quote from James Montier is brilliant. And I don't know if many of you read James Montier, but there's a brilliant book he wrote. There's a whole series called the Little Book series, and he wrote the Little Book of Behavioral Investing, and I think everyone must own it and read it. It's such a fantastic little text, and it only takes they're quite short, those little books, unsurprisingly, because that's why they're called little books. But this is a quote. I'm not sure if it came from that book or another one of his, but he was a city analyst at SocGen. He now works at GMO as a fund manager, so he's sadly not writing as much, but he's one of the best analysts in the city. He's absolutely brilliant writer, very statistically driven, and he said the bottom line is that we find it very hard to predict how we will behave when placed under pressure. Do the work with a cool, rational head, well ahead of the time when you might experience the impact of emotion, and then pre-commit to that course of action. Hence, when the emotion strikes, the action is already set in motion and you cannot interfere. Now, there's two ways you can look at that. You could say, okay, there's a profit warning, a stock's going to fall a certain amount, and you could set an order. I don't think that's the right thing to do. I think the right thing to do is have an understanding of the sort of base rate or batting average of stocks in profit warnings and react and act accordingly. Try and pre-commit to that if you think that this thesis is true. So the key insights from this section: there's no escaping profit warnings. If you own shares, you've got to expect profit warnings and prepare a plan for dealing with them. Own defensive shares to minimize the number of profit warnings experienced in a portfolio. Avoid the cheapest shares. Avoid underperforming shares and shares with poor earnings forecast trends. When a profit warning strikes, consider selling or selling short immediately. Only consider buying or continuing to hold if the shares are of the highest quality. Traders should only consider buying the bounce if the shares have fallen by more than 30%, but beware the risk. So that's the kind of the key points. I did a quick Google search for some recent profit warnings, and I've got a couple of sets that I'm going to look at. But if you search for profit warning in Google, you often find press, and often the press can be quite bullish. But I just did a quick search last night, and I saw Debenhams in January. That's actually a 2017 profit warning, but they had another one in January this year. Carpetright had another one in March, and they had one previously at the beginning of the year. So there's a couple of profit warnings. And then Mossbros, again, a couple of sequential ones. And those were the three profit warnings at the top of Google. And you see they've all followed the pattern. They've all followed the model. I'm going to go and just jump to the browser in a minute, but just to show you a set of recent profit warnings from last year, just to reiterate these points. But a quick one on the resources, because we wrote this up in a small ebook, and you can get the ebook online. It's completely free to download at stockopedia.com/books. You can go /books/profit warnings. It's a very quick read, but it reiterates these points I made in the talk. And you can get it for your Kindle or for iPad, and you can download it on the site for free. There's also so you just go remember /books, and you'll find it in the list there. There's also Ernst & Young do a lot of research every year. They have a team that studies profit warnings, and sadly they don't publish the names of the stocks, which I think is quite annoying. But they do find exactly the same idea. So for the third quarter last year, the average drop was 16.2%, which exceeds even the 2008 peak when warnings sunk stocks by 14.6% on average. And they were saying that the average fall in the fourth quarter was looking more like 18%. So you can see, even though we weren't looking at large caps, they look at the whole market. And it so regularly just follows this model. And there's a lot of academic research which follows it too. So I was just going to quickly jump to the browser and just show you some charts of so I asked somebody in the office to have a little look at and get me a little list of profit warnings. And we just created a little list more recently of, so after we'd done the study, but with enough time so that we had a year of results afterwards. And I just took from the first 3 months of last year, just got another little working set. It's a very small set. But you can see I looked at the full, sorry? Oh, you can't see it. Okay, hang on a minute. Hang on, I'll mirror my display, and then you'll be able to see what I'm looking at. Okay. And annoyingly, that doesn't work very well. But if I was to load up any profit warnings into the browser, you'd see a very, very similar pattern. So I've got, for example, a list of tickers here, and I can just add them into the chart. I bet my internet is working. And you can see here, it's almost in all these cases, the very same picture happens. The profit warning's there, and you get this decline, and it's just so consistent. And if anybody wants to sort of name a profit warning, I'd be very happy to just bring it up. But I'm not going to load all of these ticker symbols, but this is Tasty Group, and knowing me, this will probably be one that recovers. I don't know why it's not loading. I think the internet might not be working very well. Hang on. There it is, yeah. So, but you see the same sort of picture. If anyone remembers a profit warning, I'm very happy to load it up. But other than that, that's most of what I wanted to talk about, and I'm very happy to answer any questions if you've got them. Thank you.
Okay. Any questions from George?
Thanks, Ed. It's interesting research. Do you think there is the possibility that there could be a self-fulfilling prophecy, effectively, from the learnings from your study in terms of, when there's particularly small caps that many people in this room might be invested in, come out with a profit warning, everyone's sort of heard to the exit?
Well, I think before we did the study, I've been very, very pleased to see that many people have told me that since the study, they've definitely acted differently in the profit warnings after a profit warning, and I think that's been, and they say it saved them money, but I've only got anecdotal evidence of that from people's conversations. Certainly, what we want to do again is do the study again and see what happens. But the thing is, I think the private investor community is quite small, and compared with the institutions, so. Are you cutting me off there?
Sorry.
The last time someone did that to me was at the UK Investor Show. Turned into a little bit of a fight.
You won.
Thank you. So, I mean, could there be a self-fulfilling prophecy? Well, I don't know. I think if everyone suddenly jumped for the exits, you'd probably find that the post-profit warning decline happened less. So you'd probably see more like the curve would flatten, right? Because you get probably more rational pricing straight after the profit warning. But I don't think that. I mean, it would be very, very interesting to see. I couldn't really properly answer the question without looking at the data. So I'll get back to you on that. Yes, sir.
That's here. Sorry. You mentioned, so if we get profit warnings, we should sell or sell short. If you were going to sell short, how would you go about that?
Well, I of course would never advise anything. Everyone has to make their own decisions. I do like to go with the numbers. I think, one of the problems in small caps is spreads. Shorting, obviously you can make a lot more money on the upside, than you can shorting, and you can lose infinite money shorting, of course. So, you have to think, especially amongst small caps, shorting can be very difficult. And I've done quite a bit of shorting using IG, but it gets harder and harder to short small caps. Anything less than $1 billion market cap is hard to short, and they can't get the loan stock. So I know that some people probably in this room have brokers who are able to get hold of stocks. They can do proper shorting, but I've always shorted through spread bets. But I have never shorted after a profit warning. Shares get so volatile, and volatility in a short is probably the last thing you want. But I think, I personally think, my instant reaction on profit warning is to sell. So, but I've trained myself to be quite good at cutting losers generally. So, I do have a sort of tiered, phased sort of stop loss process that I run that is not mechanical, but it's more my instinct now, because I just train myself out of holding losers. So there's a question here.
Maybe interpretation of the rules seems to have changed, but quite a lot more profit warnings seem to come out not at the beginning of the day, i.e. during the day and so on. But it appears that advisors are saying, look, as soon as you are aware of the change, you have to announce that. And even though the company, in making its own announcement, may not be aware of the full effect, which then leads to another profit warning when... Yes,
I see. So they're airing bad news early, but they don't know the full extent of the problems. Yes. Well, I mean, I saw in a couple of those I just picked up, like Moss you had a couple of profit warnings quite quickly in succession. So I think whenever we do refresh the study, and I can't promise when it'll be, but I will be looking again much more closely at the kind of the serial correlation of whether that you have multiple warnings or more incidents of them. Any other questions? There's one over here and one there.
Thank you. I'm not sure if it's more of a conservation question here, but I think Paul Scott takes a similar view, but not all profit warnings are equal. So, and I do probably want to see if one held or sold, whether that would be silly or inspired, we wait to see, but there we go, just observation.
Well, Paul, of course, I've actually got a quote from Paul that's in the ebook. I don't know if I've got it here, but there was a quote from Paul, and I was just refreshing my memory of some of the work we did on this. And Paul actually says, I can't find the exact quote, but Paul does like to buy on profit warnings, you know. And the thing is, if you are somebody who you know has a much richer grasp of an individual company's situation than I do, because I'm a quite systematic investor nowadays. You know, I used to get heavily detailed into accounts and so on. If you can make that judgment, you know, obviously there can be an opportunity there. But I think, you know, statistically, it was only, I can't remember what it was on my slide, but only 1 in 10 shares ends up at a higher price 1 year on. So, you know, you got to remember, I always think about base rates and odds, you know, fingers crossed, exactly. So, you know, it's just worth I always say, you know, try and understand the batting averages of situations, and then, you know, because then, you know, you have to double think, you know, to ensure that you think you really have a good bet on there, because, you know, it's always just batting against the averages, and you want to be always trying to bat in high batting average areas of the market.
Thanks.
Load RWS, please.
Yes.
I'm one of the guys who got one. It doesn't look that bad.
Oh, was that just a couple of days ago?
Yeah.
Okay. So, I mean, if I was to load the stock report, I mean, from well, look, RWS has a quality rank of 82. So, you know, in terms of the rules of thumb that I presented, it has a higher quality rank, which would make it amongst that set of more likely companies to recover in price 1 year on. So if I was to go back to the presentation and show you this, where is it? Where's the slide? Hang on a minute. Where was it? Sorry, bear with me. But as I did say, the rule of thumb was that something like that, an 82, is more likely to return. Here it is. This is the quality rank versus the 1 year recovery. That's 75, so 80 is here, and that's the zero line. So I don't know what the stats are. But it does look like more than 50% of those higher quality shares 1 year later have a recovery. Now, some of those recovered, axis goes up to 150%. So one share did recover like up to 150%. But look, I don't know what the outcome of RWS is going to be, and I think you'll probably all hold me to it now in a year's time. But you topped up. Well, you know, by these rules of thumb, that doesn't seem like a bad decision. So I don't know if that helps give any comfort to the decision. Any other questions? Couple at the back.
Are there any sectors where this works differently? For example, agriculture companies where they have a bad year and then things stock falls a lot and then it comes back. It's something I've noticed that I wouldn't.
Yeah. Well, I didn't break down the sort of these recovery situations into different sectors. Like it's a good question. Is there a propensity for a certain sector, the companies to recover more than others? I just looked at the count of profit warnings in specific sectors. So I don't have the answer to that question, and I think it's best I say I don't. But it's a good area for research in the future, I think. There was one more over here.
Yeah, one more.
Could you load up ticker CAR?
Hang on. So I guess there was a profit warning there, and it is recovering. So that is one of the few that has actually recovered nicely from that from that initial profit warning. I mean, we've got quite a poor quality rating on it, of 26, and which seems to be going down. And this is obviously a very, very cheap share. That I think with something like Carclo, we've got it as a value trap at the moment. It's very, very cheap, and I don't know. I know nothing about the business, so I can't tell. But you look at the profit warnings world, you might think, well, there's been one profit warning. It's very, very cheap in that very cheap bucket, which has a higher propensity to have future profit warnings. But the quality rating is and the quality rating is very low. I can't really comment any further. One more question?
Could you put up the stock ranking just before it?
Oh, the stock ranking before, so that was about before January 2018. So if you go back, what day was that on? January the 11th. So if we go to January the 6th, you can see, well, there was a stock rank 56. It had had been trending down. Momentum rank was quite low. The quality rank was very moderate, as I said, there's no kind of, because profit warnings seem to happen everywhere. It's very hard to sort of say, oh well, this was definitely going to be a profit warning, but it was certainly just a very cheap share with poor momentum. And as we saw in those slides earlier, we saw here that cheaper shares, especially with a rank of 80 plus, the cheapest 20% of the market, and the lower momentum shares of the market have a propensity to profit warn more frequently. So if you take that back here, you can actually see the value rank was 87, the momentum rank was 38. So actually it fitted that model almost perfectly.
Earnings manipulation.
And yes, there's earnings manipulation risk there. So always a good red flag. Again, these measures here, so the earnings manipulation risk, they are statistical, so they show a propensity for stocks on average with those flags to have manipulation, but they're never 100% accurate for everything. So it's always wise to remember the statistics. I think that's it. Shall we? One more question?
I found the whole warning the word quality ringing in my ears. What are your parameters for quality?
Well, we actually, so I can show you, if I just click through, have an article on this, and I've sort of been promising I'm going to be doing another webinar on the way that we compose the stock ranks, and the quality rank will be part of that. But really, we looked at all the academic research on quality and what pays off and what metrics work best. And there are sort of naive measures of quality that are very popular. But some are more predictive than others. So things like return on capital, return on equity. There's a whole generation of equity analysts brought up on Warren Buffettisms of looking for high return on capital shares. And it still is obviously a very good place to start looking. What we look at, and I've got it in this help article on the quality rank, and I was thinking about doing a webinar just on this at some point, but we look at really three dimensions. Is it a good company in terms of the quality of its franchise? So that's more the kind of things that are kind of more Buffett-esque way of looking at it. And we look at long-term measures, because often you can get companies having a more recent dip in their quality, but we wanted to have a good factor of the persistence of profitability. So we look at long-term average return on capital employed. We look at the long-term gross profits to assets. This is called gross profitability. And it was a measure made famous by a chap called Robert Novi Marx in some research papers. And he's a great writer and he's a great analyst. And if you have like an income statement, it goes from gross profits down to net profits. Now, as investors, we tend to look at net profits and the net profitability of a company, because that's what we earn as shareholders and feeds into the EPS figures. But actually, he found that the best metric for predicting future growth of share prices was a measure of gross profitability. So it's higher up in the income statement. So that's quite a heavy weighting in that factor. We also look at free cash flow to assets and the stability of margins and stability of sales growth. And then the two other dimensions we look in, we use the F-score quite heavily. the F-score is basically a 9-point checklist that looks at, on many of the questions in this checklist, look at whether a company's fundamentals are improving. So we'll say things like, is it more profitable than last year? Is it generating more cash than last year? Is it paying down debt? Is dilution is there not too much dilution? And that F-score, we have almost like a third weighting in our quality score, because again, it's been seen as a very, very predictive checklist for future returns. And then we also have certain sort of decrements on quality which look at safety. So we look at bankruptcy risk, earnings manipulation risk, and also just overall leverage. So that's kind of, things like earnings manipulation risk is, if somebody's manipulating earnings or cooking the books. The bankruptcy risk obviously speaks for itself, and we use some academic measures for that. So those are all the things that pour into our metric of quality. And I know, quality is one of those things that people often don't agree on. And certainly company executives that have low quality scores tend to get quite upset. There was one last week that had a quality score of 0, in the stand opposite us. And he was, how can you say this is low quality? We have fantastic, he was talking about how great the business was. But it had made, I think, 3 million in sales and lost 11 million last year. So I think it was amongst the worst return on capital in the whole in the whole market. So but I think it's a fairly, a lot of people have different opinions. I often get a lot of people writing in saying, I think you should weight this more and weight this less, but that's how it is. And at some point, I want to let people generate their own rankings for themselves. So I think should we wrap it up? Happy? Okay.
Great.
Thank you.